Imagine you're buying a $500,000 house. You put 20% down, so you need a $400,000 mortgage. A few years ago, at a 3% interest rate, your principal and interest payment would have been about $1,686 a month. At roughly 6.7%, that same mortgage costs about $2,580. Normally, this is where the story should get really simple. Mortgage rates explode. People can afford less. Buyers disappear. Sellers lower their prices, and the housing market crashes. Except that never really happened. In June, the median existing home in the United States still sold for a record $440,600. Buying a house got dramatically less affordable. And the reason is that higher interest rates didn't just screw over buyers, they trapped sellers too. Think about the person on the other side of that $500,000 house. Maybe they bought it in 2021 when mortgage rates briefly fell as low as 2.65%. They've spent the last 5 years paying a ridiculously cheap mortgage, and now they want to move. Maybe they want a bigger house, a nicer neighborhood, or they finally had enough of their neighbor revving a Dodge Challenger at 6 in the morning. So they look at another house and discover that moving means replacing their 3% mortgage with one closer to 7%. So they do the financially responsible thing, absolutely nothing. They stay where they are, and they're definitely not alone. Nearly half of outstanding US mortgages still had rates of 4% or lower. So buyers disappeared, but sellers disappeared with them. Existing home sales fell from an annualized pace above 6 million in early 2022 to below 4 million by January 2026. But now that explanation is starting to break down. In June, the national median listing price was down 2.5% from a year earlier, and almost 19% of listings had received a price cut. If the entire reason prices stayed high was that nobody wanted to sell, then more inventory should finally cause the giant housing crash buyers have been waiting for. Except most homeowners still don't have to sell. A homeowner can watch their Zillow estimate drop, decide they don't like the number, and simply wait. Their 30-year fixed mortgage doesn't care that the market is slowing down. Unless a job loss, divorce, relocation, or financial problem forces them out, they can sit there for years. And that's one reason comparing every housing slowdown to 2008 gets sketchy very quickly. A housing market doesn't violently collapse just because buyers think prices are stupid. For a proper crash, you generally need a lot of people who have to sell into a market where very few people want to buy, which means the housing correction might look much more boring than people expect. Instead of a $500,000 house suddenly becoming a $350,000 house, it might stay around $500,000 for years while incomes gradually rise, inventory increases, and mortgage rates eventually become less painful. In real terms, housing can become cheaper without the sticker price dramatically collapsing. National home values were still rising year over year in May, just nowhere near the insane pace of the pandemic housing boom. And then there's the final trap. Most buyers are waiting for mortgage rates to fall because they assume lower rates will finally make homes affordable. But every other buyer is waiting for the exact same thing. But millions of people who have spent years sitting on the sidelines suddenly gain purchasing power at the same time. So the thing buyers are waiting for to make housing cheaper could also be the thing that pushes prices higher again. That leaves the housing market trapped. So the same thing that was supposed to crash housing ended up helping keep prices alive. Higher rates made homes harder to buy, but they also gave millions of existing homeowners a reason not to sell. And until that lock breaks, buyers may not get the dramatic housing collapse they've been waiting for.